Financial and Investment Management class.
Yes, and in this video, we are going to learn about the basic concept of financial management and also why it is important to learn about the financial management. Financial manager plays an important role in the development of the company. If previously financial managers only had the main task of raising funds and managing financial position, then over time, financial managers also had the responsibility of managing assets for investing and selecting capital investment projects. This is due to increasingly tough corporate competition, technological changes, volatility in inflation and interest rates, economic uncertainty around the world, fluctuating exchange rates, changes in tax laws, environmental issues, and ethical issues regarding certain financial deals that must be addressed almost every day. Finance is the science and art of managing money that can affect the life of every person and every organization. Finance deals with the processes, institutions, markets, and instruments involved in the transfer of money between individuals and between businesses or government.
And now, the definition of financial management. Financial management is management related to obtaining funding and asset management with several general objectives as the background. The function of financial management is broadly described by paying attention to the role in the organization, which is have a relationship with economics and accounting, the main activities of the financial manager and the manager role in total financial management.
Now I will explain you about the relation between finance and economics. First, finance is closely related to the economic. Therefore, financial managers must understand economic problems and be aware of the consequences of various levels of changes in economic activity and policies. Second, the operating efficiency of the financial manager's firm must use economic theory as a guide. Third, the main economic basis used in financial management is marginal analysis. And fourth, marginal analysis is the basis of financial decisions that will be made and carried out only if the additional benefits are greater than the additional costs.
And now I will explain about the relation between finance and accounting. So there is a basic difference between finance and accounting, namely in cash flow and decision making. First, in emphasis on cash flow. First, the main function of accountants is to generate and provide data to measure the state of the company, determine its financial position, and pay taxes. Second, the approach usually used by accountants is the actual method. Third, financial managers place more emphasis on the cash method to maintain the company's ability to pay off its debts by analyzing and planning the flow of money. Now, the emphasis on decision making. We have two decision making. First, accountants collect and present financial data. The accountant's role is to provide consistent development and ease of interpreting data about the company's past operation, now and in the future. And second is the financial manager evaluates the accountant report, develop additional data, and make decisions based on estimate of taking a risk.
Well, are you getting interested in being a financial manager? Let me tell you the main activities of financial manager. First is make financial planning and analysis. Second, make corporate investment or asset management decisions. And third, make investment financing decisions or debt and equity management. Now, what are the role of the financial manager in total quality management? Well, total quality management applies quality principles to all aspects of company operations, an important concept for a financial manager. Total quality management is a company goal that broadly affects all departments. The principle of total quality management includes continuous efforts to improve operations through streamlining of processes to achieve a more effective process and meet the satisfaction required by all internal and external factors. Commitment to total quality management is directly related to earning.
Okay. Now, I will explain about the financial management decisions are divided into three. There are first, investment decision. Investment decision is when a company wants to create value, financial manager must be able to identify investment opportunities that provide higher returns for the company than it costs. This begins with the determination of the total assets the company needs to have. Second, we have funding decisions. In this case, the financial manager deals with improving the right side of the balance sheet. In this funding decision, the company's dividend policy must be seen as an important part. And the third is asset management decisions. Once the assets have been acquired and the appropriate funding is available, then the assets must be managed efficiently.
The goal of financial management is to maximize the current value per share of the existing shares. Why should the value per share increase? Thus, the company's finance have been trusted by the public and have becoming a growing company. To develop the company more widely rather than issuing a number of more shares, it will be more effective to increase the share prices. A more general objective is to maximize the market value of the owner's existing equity or capital.
Now, you must be know the role of the financial manager. First, obtaining funds from the capital market by issuing stock or bonds. Second, using the funds obtained from the money market for the company's operation by buying real assets. Third, turning on the company's operation with the money obtained from retained earnings. And the fourth, pay dividends or bond interest to investors and creditors. Now we will discuss about the time value of money. Basically, the value of money will change over time even though the nominal is the same. The present value of money will be different from the value of money in the future. Time value of money is a central concept in financial management. Basically, financial management is an application of the time value concept of money.
Well, as the financial manager, you should understand that there is a difference between accounting profit and economic profits. Accounting profit is the most widely recognized profit because it is recorded in the company's income statements. The calculation of accounting profit is carried out using the formula accounting profit equals total revenue minus explicit expenses. Explicit costs are costs that are self-explanatory and easy to determine have been reduced. In standard accounting rules, companies are required to disclose accounting earnings. Now, the economic profit. Economic profit is calculated in a different way from accounting profit, including calculating additional or implicit costs. The implicit costs incurred by the company are the opportunity cost faced by the company in choosing one of the available alternatives. The formula for economic profit is total revenue minus explicit cost minus implicit costs. Accounting profit will always be higher than economic profit because economic profit also takes into account additional opportunity costs borne by the company. Accounting profit is usually recorded in the company's income statement, while economic profit is usually calculated for internal decision-making purposes. Accounting profits sometimes overestimate revenue because they do not consider opportunity cost and economic return. It is essential to select the option that produces the highest value.
Okay, now we will discuss about the impact of inflation on financial management. First is impact for the interest rate. An increase in the estimated rate of inflation will be translated into high interest rates. Then, the higher inflation rate means that the cost of obtaining funds for the government, business, and individuals will increase. Second impact is planning difficulties. Business enterprises operate on the basis of long-term plans under conditions of rapidly soaring inflation, where raw material costs and wage are uncertain, with precise prediction necessary even if they are difficult to do. Third impact is for the demand for capital. Inflation causes an increase in the amount of capital required to carry out business activities in a certain volume. If the inventory is sold, then the item must be replaced with a higher procurement cost. Then the fourth impact is for bond prices decrease. If interest rate increase, the price of long-term bonds will be decreased. And the last impact is for accounting problem. If the inflation rate is high enough, the reported profit will diverge. Sales of inventory with low procurement costs result in higher reported profits, but cash flow is reduced when the company has to replenish inventory with more expensive repurchase.
A financial manager is needed in some basic form of organization. Individual companies are the oldest form of business organization. As the name implies, an individual company is owned by only one person who owns all assets and is personally responsible for all company debts. A partnership is a form of business in which two or more people act as owners. In a general partnership, all partners have unlimited liability for the company's debt. But in a limited partnership, one or more partners may have limited liability. A corporation is a form of company that is legally separate from its owner. Its characteristics include limited responsibility, easy transfer of ownership, unlimited lifespan, unlimited capacity, and the ability to raise large amounts of capital. A company with large responsibility is a form of company that gives its owner, who is called a member of limited personal responsibility, such as a corporation, but the federal tax treatment is like a partnership.
Okay, now this is the end of our material today.
And if you have any question, don't hesitate to ask us about the materials in the comments below.
Don't forget to like, subscribe, and comment this Miss Inaya YouTube channel. Terus apa sih?
We'll see you in the next video and bye-bye.
Bye.
Assalamualaikum.
Assalamualaikum.